couple of days ago, we were over 380,000, 383,000 yen. That's 38% increase in 1 year. So you can see as the yen has really gotten into trouble, gold has done what it is supposed to do, and it has gone much, much higher. So I'm not worried about where gold and silver end up. I think this knee-jerk reaction is exactly the way our clients are reading it, and it's a subsidy, it's an opportunity. Um, what we're seeing is a currency that's collapsing, and all the intervention in the world, what it perhaps has done is prick the everything bubble, and that's kind of the way that it looks like right now with everything getting clobbered.
Last Friday's weaker-than-expected non-farm payrolls report drove U.S. stocks sharply lower, sending Asian and European equity markets into a tailspin as they opened up for Monday's trading session. The Nikkei was particularly hard hit, partly because it is a deep and liquid market, but partly also in response to the Bank of Japan's policy change and the associated 12% gain in the yen over the dollar in the past 4 weeks. AndySchectman, the president and co-founder of Miles Franklin, a reputable precious metals dealer, has built a distinguished career focused on helping clients navigate the complexities of investing in gold, silver, and other precious metals. Schectman emphasizes gold's performance in the yen, highlighting how it has risen dramatically as the Japanese currency has weakened, demonstrating gold's role as a hedge against currency devaluation. In the short term, gold followed risk assets lower before prices recovered to pull back above support near $2,400 per ounce. Schectman views the current price declines in precious metals as an opportunity for investors rather than a cause for concern about the long-term outlook for gold and silver. Gold prices have been consolidating within a range influenced by opposing forces. The risk-on sentiment from a relief rally in equity markets was a headwind for the safe haven metal. Meanwhile, rebounding U.S. Treasury bond yields supported the U.S. dollar, further limiting gold's upside. Despite this, gold remains supported by expectations of larger interest rate cuts by the Federal Reserve due to softer U.S. economic data and persistent geopolitical risks in the Middle East. Please tune in for our exploration of AndySchectman's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
It's been a really very busy, busy, busy day today. I think people, Chris, realize that things are beginning to break, and they realize that a sell-off like this often happens counterintuitively. I never know what to make of it. People say the conventional wisdom is that you throw out the baby with the bathwater in order to meet, for example, margin requirements. And if you look at the unwinding of the carry trade, it would certainly, with the yen strengthening the way that it has been, it would elicit margin calls on these levered positions. And whether or not it's people selling their gold and silver because it's so highly liquid, or it's just the cartel's way of continuing to step on things to make the perception of gold and silver being the place to run, kind of trying to sever that relationship, which is more along the lines of what I think people are seeing through that. The tricks and the methods that have been used for a very long time, I think, are growing long in the tooth, and they are becoming far more transparent to the investing public. And I would say today has been one of the busiest days we've had in months, literally, maybe even going back to last year when we had the banks fail. People are not dissuaded whatsoever. In fact, I think they're quite incentivized to see the value that is found here in a price that clubbed. Although it's interesting with gold, it's back above $2,400 and only down a little bit right now. The futures I show only down $23.50. They were down as much as 70 plus earlier this morning. And so I think that this is a short-term knee-jerk reaction, but I don't think we're out of the woods yet in any respect as to how this all plays out. One other note, I think it's important when we talk about what gold is doing, and when you look at it in the light of Japan, where it looks like, by all intent and purposes, the wheels appear to be coming off. 10 years ago, an ounce of gold was about 140,000 yen. 5 years ago, it was about 150,000 yen. That's a 7+% change in 5 years. It was 200,000 yen in 2020 and roughly 250,000 yen in October 2022. In 18 months from 2020 to 22, the price of gold went up $25 in yen. It spiked to 278,000 yen in July of 2023. And as of just the other day, not too long ago, just a couple of days ago, we were over 380,000, 383,000 yen. That's 38% increase in 1 year. So you can see as the yen has really gotten into trouble, gold has done what it is supposed to do, and it has gone much, much higher. So I'm not worried about where gold and silver end up. I think this knee-jerk reaction is exactly the way our clients are reading it, and it's a subsidy, it's an opportunity. Um, what we're seeing is a currency that's collapsing, and all the intervention in the world, what it perhaps has done is prick the everything bubble, and that's kind of the way that it looks like right now with everything getting clobbered.
The global rate cut cycle is picking up steam, with half of developed markets' central banks having begun easing and the U.S. Federal Reserve setting up a potential move in September. Investors are also closely watching the Bank of Japan, which has taken a different path by raising interest rates to their highest level in 15 years. Mortgage interest costs and rents are significant components keeping inflation above central bank targets. In Canada, headline inflation stands at 2.9%, but when mortgage interest costs are excluded, inflation runs at approximately 2.1%. In comparison, the U.S. headline inflation is 3.3%, with core inflation over 3.4%. The strength of the U.S. economy allows the Federal Reserve to remain on pause longer than the Bank of Canada, indicating that the challenge of achieving monetary equilibrium remains complex. As recently as March, markets anticipated 3 to 4 rate cuts by the Fed through the year's second half. However, the Fed's latest dot plot suggests only one policy rate cut toward year-end. Should U.S. growth, inflation, and employment data remain stronger than expected, it is plausible that the Fed may not need to cut rates at all this year. AndySchectman notes that central banks and governments are in a difficult position, trapped between inflation and austerity. Raising rates could destabilize the financial system, while not raising them could lead to runaway inflation. Schectman's insights reflect the precarious balance that policymakers must maintain in navigating the current economic landscape. Let's get back to the interview.
They're trapped between inflation and austerity. They're trapped between if they raise rates, they blow up the system. And if they don't raise rates, and again, that would be to keep inflation in check. And if they don't, which they won't, you're going to see inflation, I think, just get out of control. And even even if the budget was balanced today, we still have nearly 200 trillion in funded and unfunded liabilities that need to be paid for. We are a country that is addicted to spending, period. And at the level of debt creation, they have no choice but to lower rates. The whole system is on the verge of breaking apart. They will do what all governments have done since the beginning of time, and that is acquiesce to inflation. There's all this talk of the massive insider selling and Buffett selling $71 million worth of Bank of America shares and dumping his Apple shares. And the insiders see something coming, no question about it. And the Fed is late in all of their actions. This will be no different. We are not out of the woods yet, and a 50-point or 75-point decrease in interest rates isn't going to do much for it anyway. I think one of the things that's worth mentioning, everyone focuses on how good gold has done and laments at silver's performance, and I think that's part and parcel with the way that we expect markets to behave these days. We've seen such massive increases in prices that happen so fast in tech and in crypto that we don't really notice. But look, silver's rallied by over 100% since its low in 2020. It's up 105, 110% from its low point of under $12 an ounce. And I think that probably comes as a surprise to people who are just following silver kind of passively, watching gold at $2,400 an ounce. Silver will have its day, no question about it. And I think guys like Warren, I'm sure they notice very well and understand very well gold and silver, and probably have a significant position in it, just don't tell the world about it. They make their money he makes his money on equities. And so I understand that, but I think for him to expect him to not understand it. Look, gold has outperformed the S&P 500, even with dividends reinvested, for 25 years. It's averaged 9.9% compounding since the beginning of the century. That's outpaced just about anything Warren owns. And I think it would be foolish to assume that he doesn't own any. He may not talk it, but when you have the wealth that he does and your influence is centered around traditional assets and securities in American corporations, that makes sense to me. But oh, don't be surprised if he and others like him have nice stashes of gold and silver physically held safely away somewhere to protect even his large stack of cash. So I guess we'll have to see if he's going to add any to Berkshire Hathaway looking for a value. You sure think he'd find some in the mining shares. I know he's added mining shares before. I don't know. I haven't looked lately to see if he has any in there now, but geez, I couldn't think of a better place to find value for a value-based investor like Warren.
Given the precarious balance between inflation and austerity that central banks and governments must navigate, how should investors position themselves to safeguard their portfolios and capitalize on potential opportunities in this evolving economic landscape? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.